of goods. I'm not materialistic. If my policy has a $250,000, like a 50% personal property limit, is there different insurers that have different limits for that, so I can kind of only pay for the coverage that I need?
The limits, there are different limits, but nothing would go below 50%. And the majority of the preferred companies are at about 70%. So even if you had less, there would be no way to get less and try to save money. There's no way. You can't live in your house for the next 3 or 4 months. Meanwhile, you have to put stuff in storage. You may have to live in a hotel for 1 or 2 weeks until you figure out what's up. You may then have to go rent a short-term rental, which is not going to be very inexpensive, certainly more than what you're paying for your mortgage. And then you got to pay to move everything back in. And then you have meals out and all those kinds of things. All those extra costs above and beyond what you would have paid for your mortgage had you lived there are covered under loss of use. So you're still attached to my home. So when we're talking about the dwelling, we are talking about anything that would be permanently attached. So if you picked up your home and shook it upside down, anything that fell out would be under a different area of insurance. Anything that would stay attached would be part of your dwelling coverage. So one of the questions we get is, well, what am I actually covered for? Well, most homeowner policies cover you for major things: the fire, smoke damage, vandalism. They may cover you for, talk about a little bit about claim settlement when we're dealing with both personal property and dwelling. What most companies will do, let's say you have a loss of some sort, whether it be a theft loss, a fire loss, but something that as a result you've had this loss. What most insurance companies will do is they'll get an inventory. They'll ask you for an inventory and what you had. They're not going to ask for receipts typically. If there's a fire, they know you had a sofa. They know you had a dining room table. So typically you're not going to have to 10%, meaning you're going to see $50,000. Now, you have the ability to raise that limit. You never have the ability to go below that limit. So the insurance companies are always going to give you a package policy, at least to start with, and then it's up to you to work with your broker to decide, do I need more coverage in that area? So again, typically other structures come out at about 10% with most policies. Personal property. So if you remember my example about picking up your house and shaking it out, now in Ventura County, is you have all these people who need contractors to fix their homes. So there's a demand for contractors. Well, what do you think the contractors are doing? They're, of course, raising their rates. Of course, they're also having to buy supplies and having to either go further for supplies or pay extra for their supplies because the supplies are in demand. So if you've tried to, I'll call it, cheat the system and not have proper coverage on the house and use the extended replacement to make up the difference, you could actually find yourself will pay the difference. Most companies, if it's something really small like that, I've seen limits of $2,500 or $5,000, meaning you get a small theft and it was, $3,000 theft. They're not going to go through that trouble of saying, okay, here's, $2,000 now and we'll give you $1,000 later if you show us you replaced everything. So typically on a small claim like that, they'll just go ahead and pay the replacement cost. But on a larger claim, they want to see that you've actually replaced those items.
Great to know. Okay, thank you.
Okay. To do that, you can't buy it a la carte.
Gotcha. And then for the personal property, you kind of mentioned replacement costs being something that they'll only pay you if you actually replace the item. Is there the replacement cost provision in homeowners insurance? Is that go around that, or is that what you're talking about specifically?
That's what I'm talking about. That provision with most carriers will say, if somewhere in the policy language, essentially will say something to the effect, if you replace it around and they tripped and fell in it and broke their ankle. All those kinds of things are covered under liability. Now, the interesting thing about liability is not limited to being at your house. So, for example, you could be walking your dog and your dog attacks somebody, the neighbor's dog while you're down the block. You're still covered. Your liability follows you wherever you go. We had a great story where we had, and it also covers all your family members as well. We had a kid explosion, water losses. And I want to spend a few moments on water losses because this is one of the hardest things that people don't really get. So they do cover water losses, homeowner policies will, for your structure, meaning like damage to the wall or something like that. But they only cover it if you have what's called sudden and accidental. Those are the actual insurance terms that are used. And essentially that just means you leave your house in the morning, everything looks good, you come home after work and all of a sudden you're standing in 3 inches of water. That's sudden and accidental. your house with the same features new today. And of course, if you think about it, you could take the same house, and let's take a 2,000 square foot house in Beverly Hills. A house like that is certainly going to be over $1 million, whatever the actual market value is, but it's going to be worth over $1 million. If we picked up that house and took it and moved it out to Barstow, that same house might only cost $150,000 to $200,000 market value. But the fact is, let's go kind of a little bit of a roadmap of what we're going to talk about today. Let's see here. Okay, so first of all, we're going to do a little overview of property and casualty insurance. What are property and casualty insurance? What does it mean? What type of insurances are involved? As Matt said, we're going to spend most of our time talking about homeowners insurance. This is particularly given the recent events with the fires and the floods and the things that have happened recently. I think it's top of mind, right? So let's talk a little bit about market value versus insured value. This is one of the things that a lot of people get tripped up on. So we talked about in the last slide about dwelling costs and that number like 500,000 we used. But a lot of people will say, well, wait a second, my house is worth $750,000. And that's absolutely true. That would be the market value of your house. The replacement costs, or the costs that the insurance companies use, are the cost it would take to rebuild and go, yeah, this makes sense. These are the features I have, or gee, I didn't have that, or I do have that, or whatever the case may be. So that's the check case. They can ask for a copy of the report if they'd like one, that the value is based on. Some give you more information than others, but you can look at that set of features and say, is this accurate for my home? Maybe you've just redesigned your kitchen or, any number of different things, but you want to look and make sure that's accurate. If there's not enough there, if they only give you just like square footage and year built and, really nothing else about it, you can ask your broker for the report that's used, and they can go back into their system and basically pull up that report, and you can kind of walk through it. Anything that would actually fall out is considered personal property. Another way to think about it is, if you moved out of your house, what would you take with you? What comes with you and what stays with the house? What comes with you is your personal property. This is usually somewhere around 60 to 75% of the dwelling number. The idea being is, hey, if you have a large house with a higher value of replacement, because there's more to replace, you probably have more stuff to replace. And that's kind of the general philosophy. Where this goes, the landlord, as we talked about that as well. We're going to talk a little bit about earthquake insurance, and we'll touch on flood insurance as well, especially, again, given what's happened recently. We're going to spend some time talking about insurance for valuable objects and valuable property. This is one of the most often overlooked sections that we come across when we're reviewing people's policies. We'll spend a little bit of time on the liability coverage, liability insurance, umbrella insurance, and an important topic for people to be giving thought to. Some related insurance coverages. So we'll also be talking about condo insurance and insurance for landlords and the earthquake insurance and some of those things that may not pertain exactly to your primary home, but might also be important, especially if you have those kinds of properties as well. We're going to talk about liability insurance, which is part of your home policy, and a little bit what it does and how it works and how to best utilize that in property casualty insurance. So let's talk a little bit about the main topic, homeowner insurance. So your homeowner insurance policy has several parts to it, and it's probably kind of something you would think about if somebody asked you. You could probably come up with these parts on your own, but we're going to spend a few minutes on each one just describing them. So the first part is the dwelling. This is the part that insures the home itself. What happens if my home burns down? Replacing my home, replacing anything that's liable for that damage. So again, it doesn't have to be at your particular location in order for there to be coverage.
Hey, John.
Yes.
I have a couple of questions on the previous slide, on the homeowners insurance slide.
Okay.
First of all, for the dwelling amount and the personal property, since they're all kind of related to the dwelling, is that something that different insurance providers have different values for? So let's say, for example, my house is worth $500,000, using your example, but I really only have like $100,000.
Well, gee, my home is older. So does that mean it's not worth as much to replace? And the answer is no. When the insurance companies value your home, and we'll talk a little bit more about how they do that in the next slide, but when they do that, they're looking at what it costs to replace new. no insurance company is going to walk in and go, hey, you know what, we have a great used window that's going to fit in that spot since that window was broken. Everything that they do is going to be replaced new with like, kind, and quality, meaning of a similar type. They're not going to upgrade it, but they're going to also do what's called extended replacement cost. And you want to make sure that your policy has this. Extended replacement cost says, okay, they're going to insure your home for whatever amount shows on your policy. And again, I'll use the $500,000. And then they add a percentage over and above that. So that percentage is anywhere as low as 20% I've seen, all the way up to 100%, or I guess you could say 200%. It doubles the coverage, however you want to say it. So that $500,000 home, you would actually have up to, it's going to end up paying your mortgage, but at the same time, all these additional costs are going to be reimbursed by the insurance company under what's called loss of use. And then the last key coverage of a homeowner policy, or the key section, is called liability. So liability is when you are held accountable for something. Somebody blames you, you are either sued for something, or as a result of, the term will be your negligence, you didn't tell somebody that there was a big hole in the ground.
We'll see those and we'll answer them. If they're applicable to the current slide, we'll try to ask them in real time, so keep everybody engaged. And if not, we'll ask your questions, and we'll have a Q&A at the very end of the webinar.
And Matt, you'll read those to me, correct?
And I will read the questions, yeah, exactly.
Perfect. So one of the major coverages, or major property and casualty, or auto insurance, we're not going to spend much time on today, but it certainly is an important part. Today's focus is primarily on the homeowner insurance, the condo. That's essentially how much towards a loss you might pay. And for those of you who are better, financially off, might be able to carry a higher deductible, which means you're taking on more risk. But what that does is it also lowers the rate. So again, those things you can't afford to do on your own is what should be insured, and those things that you can take on your own might be something that you would be willing to take on, and in that way, that's how we can work with the price. So that's kind of the philosophy we like to look at when we're doing justify everything unless it's out of the ordinary. But what they are going to do is they're going to give you what's called actual cash value for it. They're going to say, okay, well, that set of golf clubs was, you've had it for 3 years, bought it new for $1,000, it may only be worth $500 now. And then as you go and replace it, and you replace it and it costs you $1,000, then they will pay you the difference. The idea being is the insurance company is only going to pay, so at that point they'll probably do a more accurate assessment. But just to give you an idea, those are some of the numbers that you want to think about.
Hey, John,
talking about that demand, yeah.
So, as related to this slide, what's a question, or what can somebody who's talking to their insurance broker, and let's say it's not you for sake of argument, what do they say to make sure that they're going to end up being covered as fully as they need to be covered versus...
And when we do that, we're also going to talk about umbrella coverage, because that's one of those coverages I think most people don't fully understand, but would truly benefit by having a policy like that. And then we'll wrap up with some Q&A at the end. So again, appreciate everybody joining us this morning. Let's go ahead and start talking about what is property and casualty insurance. So what we've done here...
One thing I wanted to clarify, everybody, you can type your questions in your the dialog box. And
the cost to replace something for something you actually replaced. If you choose not to replace something, then they're only going to give you the value of it at the time of the loss. And that value would be depreciated, meaning it would be a little bit lower than what you might have expected it to cost new. So that's how the insurance companies will settle that sort of thing. The next area of coverage is loss of use. This is really important. So you've had a fire at your house, unit or two, and it's just whole sorts of questions. And they use that, put that into the, basically the computer program, and come up with the replacement cost of your home. Now, realistically, there's a lot of assumptions built into a program like that. So, how do you know, gosh, am I actually adequately insured? You didn't ask about the crown molding I had in my ceiling, and I know that cost me $5,000 to put in. How's that being covered? So all the insurance companies are going to put in a used window, even if your window is, 20 years old. So that covers that section. The next, oops. Okay, other structures. So these are things that are not attached to your home. This may be a pool. This could be like a shed out in the backyard. It could be a built-in barbecue. It could be a pool home, or pool, like one of those pool houses. One of the things that we see often are, and all of a sudden you get your quote back or proposal, and there's this number there, and you're like, wow, how did they get to that number? Well, all insurance companies use a third-party program. Most of them use the same program, actually, that they put in certain information about your home. So if you go back and think about when you bought insurance for your home, you probably had people asking you questions about, how big is it? Is your kitchen been updated? What kind of flooring do you have? Do you have one air conditioner? Than the actual cost to insure. And usually there's a line somewhere in there when you're doing a loan that says, or to the value that the insurance company deems worthy to insure the house for. So there's these different values out there, but for your home, from your insurance policy, it's going to be based on the actual cost to replace or to rebuild. So how is that determined? How does an insurance company determine, you talk to your broker and you say I have this house and it's 2,500 square feet and everything costs like $500,000 to rebuild based on their program. So what they'll do is they'll say, what we'll do is we're only going to charge you for $350,000 for your house, and then we're going to let that extended coverage pick up the rest to get you up to $500,000. And there's a big danger in that. First of all, it means all the other numbers that are percentages off of it may not be accurate. But more importantly, you run into issues where what happens if there's something like an earthquake? So where it's tricky and people really need to think about it is you may have a smaller house in a very affluent area, but you may have very expensive furniture, very expensive clothing, and all sorts of other items that if you added it up together might actually exceed the number that the insurance company has given you. Again, at that point, that's a conversation you should be having with your broker to make sure that you have adequate coverage. The last thing you want to find out is that you didn't have adequate coverage after the loss has occurred. The other part that I want to talk about was playing with a Wii, one of those electronic games, and it was a game where they were playing tennis, and he kept, he was serving the way you would play tennis on one of those games, and he accidentally let go of the controller, and the controller went right through the screen of this new plasma TV. At the time, it was a plasma TV were new, and it was a $5,000 or $6,000 TV, and of course he was liable for the damage he caused to his friend's TV, and ultimately the liability picked that up because he was liable. Earthquake insurance, you don't get that extended replacement. It's just the number that's on the policy. Well, two things happen after an earthquake. One, an earthquake is one of those things that's most likely to really cause a lot of damage to your house, but also it's one of those things that if it hits you, it's probably hitting everybody else around you. So what happens at that point, you get what's called demand surge. And this has actually happened in the recent fires up that were in Northern California and closer to $400 or $500,000. $400 or $500 per square foot for those, nice houses in, wherever, they're all over the valley, I suppose, in Westlake Village and all those areas. So that's a quick check. Most insurance companies, if your cost is over $1 million, if they've determined, if an agent has determined that that's what the cost is, they're going to probably come out and do a field inspection anyway, an interior inspection, and want to see the house and look at the features. The cost to rebuild the house is going to be roughly the same in both areas. So the insurance companies, the numbers that they use, don't always have they're not always collated to the value that you're used to thinking of your house. And the third value that sometimes comes up is mortgages, because the mortgage, how much you have on the mortgage, because some banks say, we want you to insure to the value of the mortgage. Well, the value of the mortgage may actually be greater. Again, that Beverly Hills home may actually be greater. That's different than you leave in the morning and you come back later that evening, you see a little tiny brown spot on your ceiling and you're like, I'm not going to really worry about it. And then you come back the next day and it's a little bit bigger, then a little bit bigger. That's not sudden and accidental. That's something that's damage that's occurring over time in a slow leak. Those sorts of things aren't covered, whereas the sudden and accidental is. So that always comes up with the home structure. The other question that comes up a lot with home structures is $600,000 to rebuild it if you have the 20% extended, or you'd have up to $1 million to rebuild it if you had the 100% extended. So that should cover most things that you would potentially miss or haven't been asked about, or maybe a slightly upgraded feature that hasn't been accounted for. Now, there's a danger, and there's an inherent danger in that. Some brokers say, hey, we know this house, really
somebody who's trying to come in with the lowest bid and do that trick where they use that the float 30% of whatever. What can they say to make sure that they're appropriately covered without obviously overpaying for something that they should be getting anyway?
Good question, Matt. What you can do, most renewals come out, most people just look at the price, but if you dig deeper into it, the renewals have a set of features of incredibly underinsured, and that is actually happening. We've heard many stories about that, even with these most recent claims. Just to give you an idea, because you're like, well, how do I know? I would tell you that typically here in Southern California, an average house, an average tract home, say in the San Fernando Valley, you're probably wanting to see the number come up somewhere between at least $175 to $200 a square foot for your house. You start to get into the nicer, more custom houses, and you're probably looking at separate garages or detached garages that have living quarters on top of it. All those kinds of things have their own coverage. So typically what you see in a home policy, if you've ever looked at your policy, you'll see all sorts of different values put on these things. And again, we'll talk about where the dwelling value comes from, but all the other coverages we're going to talk about turn out to be percentages of the dwelling coverage. As an example, if your dwelling coverage is $500,000 or $500,000, what you typically see for other structures is 10. And then another aspect of property and casualty, which we're not going to talk about today, but certainly could, if anybody had questions down the road, we could discuss, is business insurance. So when I'm looking at property and casualty insurance, I have a basic philosophy. And the idea of insurance is, what I like to say is to protect you against the big stuff, the big things that can happen. Now, a lot of times people approach it as like, how do I get cheap insurance? How do I lower my costs? So the way we work with that is we use deductibles. So for those of you who are not familiar with a deductible,